How to live off your rental income. That's today's show. Let's dive into it, everyone. Hey, I'm Clayton Morris.
I'm Natalie Morris.
She's wearing glasses because of allergies. I'm not. My eyes are puffy. Welcome.
They are puffy.
They are
It's
puffy.
not like your way is better.
No, I know. We were having a debate. Glasses, no glasses. We're traveling. We're in California. It's a heat wave, 109 degrees, and everything's dry. And even the animals are seeking shelter right now. But today we wanted to talk about how to live off of your rental income, because we were having this discussion just the other day, and it's an incredibly important discussion when you have a rental portfolio, or if you're just getting started and about to acquire a rental portfolio. You know, you can't commingle funds. You can't just pop money from one account to the next. And obviously the ultimate goal is to be able to live off of your rental income and achieve financial freedom. So if you're new to the channel, please hit subscribe. We teach you how to build financial intelligence so that you can build financial freedom. So you want to kind of set the groundwork for this discussion about how to live off your rental income?
Yes, I do. So I have seen this done all manner of ways, and we have done this all manner of ways ourselves. So when we decided we wanted to be retail investors, rental property investors, what we originally had done was I owned a property in San Francisco, and then Clayton went and bought some properties in Michigan, and we bought them in our own name, in Clayton Morris and Natalie Morris, the lady and the gentleman, right? So the property was owned and income was reported on our own social security numbers. And then we started to research how to be rental investors. We started to buy properties in an LLC, and it's just very different. So we wanted to talk about the cash flow. We're not going to, in this video, talk about why you own in an LLC. We've done that before. We have other videos that you can reference on how to buy in an LLC and why to buy in an LLC. But once that cash flow changes, now you're not getting a check. Your tenant is not writing a check to Natalie Morris, the lady. The tenant is now writing a check to Natalie Morris's LLC. So then how do you live off of that income, right? I had this cousin who, he rented a house in Fremont near where we are right now, and the landlord said, oh yeah, can you please, have the rent in by Friday because I want to put it in my account. And that really upset him. And he was thinking, oh my gosh, I'm putting money into her bank account, right? So obviously that's one way to do it. You can own it in your personal name. It's not the most tax-friendly or the safest way to do it. So that's why we talk about when you own in an entity, then how do you actually get that money into your bank account, right? It's not such a direct
off money in the wrong way, because when the IRS comes around, knocks on your door.
Right.
I mean, what is that, commingling? I mean, if you're getting rental income, personal expenses.
Right, you can't do that.
You can't do it.
Right? Again, if it's owned by Natalie Morris, the lady, I can take that money and do whatever I want the safest way. So now we're saying, okay, you have a business bank account. Let's say it's Natalie Morris LLC owns the property, right? And so now the tenant is making the payment to Natalie Morris LLC. That's the bank account that now has the money, right? And you're telling the government, this is my business. My business is that I invest in real estate, okay? So now that business you're taxed as a business. It's a more, all of your expenses run through that business. They lower your taxable burden, right? But now you can't just take, whereas before, if the tenant was paying me personally, I could take that and then buy socks with it for myself, right? Now I can't do that. Now, if I want to take that money and buy socks, the business has to pay Natalie Morris, the lady, and then Natalie Morris, the lady, can go and buy socks. So here's the thing. You can't take your rental income from your LLC and then just go and pay your mortgage with it, right? Because that's a personal expense, and we've seen people do that before. That's wrong.
Right. We've definitely had investors have told us they've done that. We're like, no, you can't do that. You shouldn't be doing that. And so I guess the question is percentages. So how much of a disbursement and how regular should these disbursements be? So are you set, or is this something that where we would want to set it up on a regular basis? So let's say for round numbers, you've got 5 rental properties, okay? They're producing a few $1,000s a month in cash flow every month. How much of that's going into your business bank account do you want to be siphoning off for personal expenses? Obviously, we want to be able to live off of this income. After all, this is why we're doing this, right?
Right.
We want to achieve financial freedom, so we want these tenants to pay for the life that we live.
This is a question we get a lot, and there's no hard and fast rule. I think it depends on your lifestyle and how much you're taxed on it as an owner draw, unless you are paying yourself a regular salary in which you're already taking taxes out. And you have to figure out what are your goals here, right? So for us, we want to live off of our rental income, so we pay ourselves a salary out of the holding company, right? And so we try really hard not to take a draw. Sometimes we have to. Sometimes some big expense comes out, or taxes come out, right? So, or something unexpected. And so we say, okay, we have to take money out of the holding company in order to pay this expense in our lives that we hadn't otherwise budgeted for. And then we're going to have to pay taxes on that at our current tax rate.
And typically, and if you recall, like Garrett Sutton talks about in his book, he talks about taking the quarterly or a yearly draw out of that account. So you're treating this as a business, and in the way that you would file quarterly taxes. So again, to Natalie's point, the way in which you want to live your life, thinking about the expenses that you have in your life, and if you have no other income, then this is the thing that will pay for your expenses.
Right.
So you need to account for that, and whether it's a quarterly or yearly draw.
Yes, absolutely. So you have to budget. We've talked many times about the profit first system. You have to budget for how much you want to take from that LLC bank account in order to live your life, right? But we've also talked about many times how we try to legitimately funnel our living expenses through the business, because we want our living things that we want anyway to be business expenses. We both want to have cell phones. I actually don't want to have a cell phone.
I won't have a cell phone anymore.
But we have to, right?
Right.
And we have to pay that cell phone bill. We don't take a draw from the LLC and then pay the cell phone bill with our personal bank account. We pay the cell phone bill with the LLC bank account because we don't want to pay taxes on that money. And then anything that the LLC pays, right, is a taxable deduction.
Right.
So little things like that we try really hard to pay for as business expenses. I was telling, I've been spending some time with my dad, and I was telling Clayton, my whole life, I remember my parents, we would go to somewhere, right, like a restaurant or a vacation, and they would say, like, the bill would come and they'd say, is business expense or not? They would say, is this a legitimate business? Can we write this off? Because we did this, because this, because we talked about business for this reason, because we went out with these people who are clients, and they would say, oh, good, this is a business expense, right? Because everything that your business pays for, again, I'm going to go back to, you make $100 as a lady, you pay taxes on $100. You make $100 as a business, but you spend $50 in expenses, you're taxed on $50, right? So you want those things that you want to do anyway to be business expenses.
Right, and so these draws, remember, you're paying taxes on them.
Right.
So it's very important to think about this. This is income. And one of the things I think the reason that investors will always say, buy until you die. There's a reason they say buy until you die. Why? Anybody out there can think of why this is? Why would a real estate investor want to buy real estate until they die? Anybody? Well, I'll kind of help you out here on this. It's because if they stop buying real estate, then they don't have those deductions and depreciation to offset the income that they're now getting for their rental income.
Yeah, I
Taxes,
remember
depreciation, exactly. That's why you keep buying, and so that is income. That becomes income.
Right. One of the first years that we really had our rental portfolio intact enough to live off of, I was having this conversation with my accountant, and he's like, cash flow is just not the best, right?
Yeah, cash is
and
not
you would
good.
think that, and I was like, this just goes against everything that I've always planned for and thought about and executed on, but you don't want that straight cash flow. You want business deductions so that you could live your life through your income legitimately, right?
And I think that's the subtext for today's show is that we don't want cash. cash, I remember, and this is not like name dropping, but I remember specifically having a lunch meeting with Robert Kiyosaki, and he said this. He had just gotten a check for $250,000, and he said, and he, around the table, he's like, I don't want that.
No,
He's like, I don't want that. I mean, I know it sounds like, oh, Robert, woe is me, right? You just got a check for $250,000. But his point was, it's cash, and now that's income, and now he's going to have to pay a boatload in taxes. He'd much rather have that in a performing asset that is being able to depreciate. So he said, I don't even want to touch this. I'm going to move this over right now to the team. He was talking with Ken McElroy, who's a big real estate investor, and he wanted to be able to then actually get additional properties because of that investment, because of that cash. He's like, I don't want to touch it. I don't want this cash. So we want to think about how we can not have cash in our hands. And I think ultimately if we have these holding companies holding certain amounts of money, so let's talk about that a little bit, right? We've got our LLCs that have our properties. They're passing that income from the tenants up to a holding company. Where does that money then sit?
I don't understand your question.
Okay, so we've got multiple LLCs
Yeah.
that own different properties, right?
Right.
Receive rent from those tenants. They go into a holding company.
Yes.
That cash flow in that holding company bank account, is it sit in that holding company bank account, or is it siphoned off and then moved somewhere else so that it's protected, and also then we're not having to deal with the tax issues?
Okay, so what we do is we pay ourselves a salary, and we pay taxes we pay it through QuickBooks. We, pay taxes in the state in which we make the salary, right? And then we try to make sure that the holding company has enough in there to pay the expenses for the business, right? We pay most expenses for the business on a company credit card, and then the holding company then pays the credit card. So we're making points on the expenses that we need to pay, and then once we keep enough in there again for turnovers, for taxes, for insurance costs, that kind of thing. But then inevitably that money is going to, start to accumulate. And then once we figure, okay, we need that, we don't want that sitting there, that cash is a liability, we either decide to buy something else with it, we'll buy another property, or sometimes, like my dad was just telling you this story, he's got those warehouses. The warehouses have accumulated enough money, and so they're going to take an owner draw. He owns it with family, and so they're like, hey, let's get together and celebrate because the warehouses have been doing well, and we're going to take this big owner draw and share it. Because it's time, right? And so you have to plan for these kind of things. Again, it's about what your goal is, right? Are you trying to accumulate enough to buy something else? Mm-hmm. Right? That's usually part of our goal. Like, great, we have enough. Let's buy something else that's cash flowing. Or do you need it to live your life out of? Do you need, last week you talked about diversifying our portfolio. A lot of times, it's like every week when you have a large portfolio, this one, we just got an email yesterday, the chimney's leaking, and this is what it needs, right? So because we're diversified, we're ready for that kind of thing.
Right, it's going to be about a $1,500 expense to get the chimney cap fixed and the flashing around the chimney, and it's one of our properties, and fine. And I just approved it with the maintenance team, get it done, but that's going to come out of those expenses. So I think one mistake a lot of new investors make is they don't set aside money for these expenses.
Right.
You're going to have expenses. That's part of this problem. That's part of this game, right? As a rental investor, you're going to have these expenses. That's why we always want to take out that 40 to 50% in our ROI formula, figuring these things out, because we want to make sure we have that money set aside in the event you have to fix a furnace 10 years from now, in the event you have to fix a chimney because of issues around the mortar, and get the masonry up there to fix that. So set that money aside and make sure that you're protected.
Yeah. I think Jeanette, is it her? She asked about contributed capital. And so what if your LLC, you want to start using the money in the bank account, right? But you don't have enough yet. You've set up your bank account, but you can't really start to pay your cell phone out of it just yet. So the money that you take out of your personal account and put it into your bank account in order to get your business up and running is taxed as contributed capital. It's not, you don't get a deduction on what you take and put into your business first, to get started. But you can put it there so that you're, starting your business, but there's no real tax advantage to contributed capital. Otherwise, everyone would just say, well, I put this in a business, and so it shouldn't be taxed, right? It doesn't really work that way. Ask your tax accountant how contributed capital into your LLC affects your tax rate.
And so, everyone, I want you to check out this video, which is the best legal entities for buying a property. You've got to check out that video, and make sure to hit the subscribe button if you are new here, and we will see you next time in our next video and our next live stream.